Hi, thank you for watching Digging to China. I'm Dong Xiang. If you have not done so already, please subscribe to my channel. Thank you very much. A major Chinese shadow bank has filed for bankruptcy, adding to worries the country's property crisis is spreading to the broader financial sectors. Beijing's first intermediate People's Court said on social media on January 5th that it has accepted the application from Zhongzhi Enterprise Group, aka ZEG. It said that the trust company clearly lacks the ability to repay debt and it had insufficient assets to pay off its dues. ZEG is a major player in China's shadow banking industry, a term for a system of lenders, brokers, and other credit intermediaries who fall outside the realm of traditional regulated banking. Shadow banking, which is unregulated, is not subject to the same kinds of risk, liquidity, and capital restrictions as traditional banks. Informal lending has always existed in China's economy, but shadow banking really took off in the aftermath of the global financial crisis in 2008, when credit was scarce. The ZEG has applied for bankruptcy liquidation. Once a general court accepts such an application, it indicates the initiation of the process to address the bankruptcy proceedings of the company. Subsequently, the court typically designates one or more bankruptcy administrators to thoroughly assess the remaining asset and the liabilities of the ZEG, determining the exact amount of assets still available and the extent of the existing debts. The subsequent stages involve selling the assets and determining the amount of money that can be recovered from these sales. Following this, the court must establish the order in which compensation will be distributed. Finally, in the execution phase, creditors receive their payments, and the court formally declares the dissolution of the company. ZEG formally declared its debt default at the close of the previous year, and within a few days into the new year, the Communist Party approved its bankruptcy liquidation. This rapid decision-making is truly noteworthy. Consider Evergrande's financial woes. They have persisted for over 3 years, yet the Communist Party has not sanctioned its bankruptcy liquidation. Why the swift action with ZEG this time? The explanation is straightforward. ZEG's financial issues mainly impact affluent individuals and do not pose a threat to the Communist Party's essential support base. Those investing in ZEG are primarily high net worth clients with starting investments of at least several million yuan. The investor count is approximately 50,000. In contrast, the negative impact of Evergrande's abandoned property projects is considerably detrimental. Evergrande, according to statistics, has left at least over 1 million unfinished properties, affecting as many households. These households likely invested substantial amounts, carrying the burden of mortgage loans. If Evergrande proceeds with the bankruptcy liquidation, these families not only face the loss of their home, but also potential depletion of savings spanning 2 generations. Additionally, they would be tied to servicing the bank for the rest of their lives, a significant setback. The potential consequences are substantial, as these 1 million households represent over 3 million individuals. If each of them takes to the streets for protest, the repercussions could be severe. Moreover, it's not limited to Evergrande. Many other real estate companies also grapple with unfinished projects. If Evergrande undergoes bankruptcy and liquidation, owners of other unfinished properties would understand their impending fate. This might lead them to step forward early for legal recourse, potentially resulting in a crisis with the millions protesting on the streets. Hence, Evergrande has been prevented from declaring bankruptcy by the Communist Party, while ZEG is undergoing the necessary bankruptcy and liquidation process. So, how severe is ZEG's situation, and what amount can investors realistically expect to recover? Let's explore the genuine financial status of ZEG. Towards the end of previous year, ZEG declared a debt default and voluntarily disclosed its financial status, specifying that overall group debt ranged between 420 to 460 billion yuan, while the remaining assets were approximately 200 billion yuan. The documented losses surpassed 220 billion. It's crucial to emphasize that these figures represent book values, indicating they are ZEG's own estimates, and that the company's assets are roughly valued at $200 billion. Nonetheless, the pivotal question persists. What is the actual potential of realizing funds from the sale of these assets? Can the estimated $200 billion genuinely be attained? This is the investigation we must delve into. So let's begin by examining the nature of the assets in ZEG's possession. Essentially, these assets can be classified into two main categories. One category of assets involves money that was lent out, such as the $1.4 billion extended to Jia Yueting. Assessing the potential recovery of this amount, I believe it's close to negligible. In 2014, Jia Yueting founded the electric car company Faraday Future in the United States, which ended up in a disastrous failure. Throughout the entire year of 2023, only 10 cars were sold, and one of them was purchased by Jia Yueting himself. The stock price has plummeted by 99%, and the company has been received delisting notices. Therefore, the $1.4 billion lent by ZEG to Jia Yueting can be considered a near total loss. In addition to the funds extended as loans, ZEG also possesses shares in publicly traded companies. ZEG predominantly utilizes equity financial as a means for generating profits, employing two common strategies. The initial strategy is known as the private equity plus listed company model, PE plus model. In this approach, the process begins with an investment in a small company and the acquisition of its shares. Subsequently, efforts are made to either locate a publicly listed company willing to acquire these shares or directly merge the small company with a listed company, forming a new consolidated entity. This transformation positions the small company as an asset within the listed company, resulting in an increase in equity value. Ultimately, profits are derived from capitalizing on the price differential, representing the first method of operation. The second method is even more direct and brutal. Let me provide an example. Imagine you have 10 million yuan and you acquire a 5% stake in company A. Subsequently, you leverage this 5% stake by using it as a collateral to obtain a loan from a bank. With the borrowed funds, you continue to invest in shares of company B. Then you leverage the acquired B company shares for another loan, which is used to purchase shares of company C. This strategy can be highly profitable during a bull market due to increased leverage. However, in the bear market, if the stock prices of company A, B, C all undergo significant declines, the leverage might become problematic. Why is this the case? It's quite straightforward. Typically, when you use shares of a publicly traded company as collateral with a bank, the maximum collateral ratio the bank offers is 50%. For instance, if you use stocks valued at $10 per share as collateral, the bank will only lend you $5. Moreover, these stock collateral loans often come with a trigger level and a liquidation level. Using the previous example, if your $10 stock is used as collateral and the bank sets a trigger level at $6 and a liquidation level at $4, here is the scenario. If the stock price falls below 6 and the collateral ratio drops below 50%, you will be required to cover the difference. If the stock price drops below 4, the bank will forcefully liquidate your position. So in this analogy, ZEG is akin to a voracious snake entangling itself by acquiring numerous shares of publicly traded companies, essentially introducing multiple layers of leverage. However, in recent years, they faced a bear market, causing the stock prices of the companies held by ZEG to continually decline. Many not breached the trigger levels necessitating additional collateral, but even surpassed the liquidation levels. At this point, the stocks lose their value, while the debt owed to the bank remains. What comes next? A financial collapse. We can discover from online sources the specific stocks that the ZEG has purchased. Surprisingly, their portfolio consists entirely of low-quality stocks, with many having names unfamiliar to the general public. Furthermore, a considerable number of these stocks are either already labeled as potential delistings or are heading in that direction. This prompts a question: why does ZEG appear to have such questionable investment choices? I believe there are only two potential answers. The first scenario suggests that ZEG might have exceptional methods to artificially inflate the value of these stocks. The second possibility is that ZEG is intentionally facilitating someone else in acquiring these stocks. The identity of this party remains unknown. Reflecting on the mysterious death of ZEG's founder Xie Zhikun 2 years ago, I believe the second scenario of deliberately aiding someone in taking over is a plausible possibility. In addition to the funds extended as loans and the shares of publicly traded companies, ZEG assets also included a substantial investment in real estate. Up until 2022, ZEG's real estate investments have reached approximately 80 billion yuan, with significant holdings in Evergrande, Sunac China, Blue Focus, and the Tahoe Group. The mention of Evergrande in the list should give a clear indication. However, this 80 billion investment is currently facing unfavorable circumstances. Think of ZEG as a financial reservoir. On one front, it relies on various financial platforms within its portfolio to attract external funds, encompassing trusts, private equity, wealth management products, and more. These inflows essentially constitute the water into this reservoir, sourced from the general public. On the other front, the funds within the reservoir must at least be sufficient to meet the redemption requirements of maturing financial products to sustain ongoing financial operations. However, examining ZEG's assortment of low-quality assets reveals an inability to even recover the principal, making it implausible for funds to circulate back into the reservoir. What's the course of action now? There are two possibilities. First, ZEG may opt to introduce more products with higher and more attractive interest rates to allure additional private funds, thus sustaining the redemption of maturing products. The second option involves taking bold measures such as disposing of low-quality assets and declaring a debt default. Clearly, ZEG initially leaned towards the first option. Unfortunately, the financial gap for ZEG is too massive, and solely relying on gathering private investments falls short of filling it. Moreover, in recent years, there has been a shift towards a more conservative investment approach, particularly in real estate-related ventures. Consequently, ZEG cannot secure enough funds through deception, ultimately leading to the unavoidable declaration of a financial crisis. As ZEG approaches bankruptcy liquidation, the cash balance in its accounts is less than 2 million, while the assets have been valued at a book value of 200 billion. However, firstly, the funds lent out are essentially lost. Secondly, even if all the low-quality stocks are liquidated, the selling process is likely to depress their price, resulting in discounted actual recovery. Thirdly, the investments in real estate have largely dissipated, and relying on Evergrande to repay the money is nothing short of wishful thinking. Hence, when discussing ZEG's liabilities ranging from 420 to 460 billion, let's exclude the interest and focus solely on the principal. Assuming a principal of 400 billion, after handling the asset liquidation, I anticipate that the 200 billion in book value assets might realistically yield around 100 billion. Consequently, in the most favorable scenario, each investor could potentially recover 25% of their principal on average. However, it's crucial to note that this represents the best case scenario. When it comes to the liquidation of a bankrupt company, the distribution of funds follows a certain order. For example, debts owed to banks take top priority. If you have invested in ZEG's financial products and the terms specify that investors willingly accept investment risks and bear their consequences, then regrettably, your share in the distribution may be reduced, or you might not receive anything at all. In any case, your claim would be subordinate to the claims of the banks. If, after selling off the assets, there isn't enough money to settle debts with the bank, ordinary investors may find themselves without any returns. There won't be a share for them. Recent payout plans from domestically bankrupt trust companies illustrate this situation. Those willing to compensate investors often manage to secure funds from state-owned entities, enabling them to distribute some funds to investors. The amount invested also plays a role in the payout, with smaller investments typically receiving a higher percentage back. For example, a plan from Sichuan Trust offered an 80% return for investments under 1 million, 70% for 1 to 3 million, 55% for 3 to 6 million, 50% for 6 to 10 million, and only 40% for investments above 10 million. However, these distribution ratios were possible because Sichuan Trust successfully secured funding from state-owned entities. In the case of ZEG's bankruptcy liquidation, there is no apparent entity to inject capital. Hence, if investors can secure the 25% return as calculated earlier, they should consider themselves fortunate. However, the more probable outcome is that they won't recover anything. Fortunately, those investing in ZEG's financial products are wealthy individuals who can absorb the losses without significant financial strain. While the losses may be regrettable, they are unlikely to cause severe financial distress, given that the number of high net worth individuals affected is relatively small, and these losses are unlikely to lead to extreme reactions. The concerns of the Communist Party are minimized. This is one of the reasons why ZEG could swiftly enter bankruptcy liquidation. Thank you for watching. Please leave a comment and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly. Until then, be well.